Hi, I'm James Robinson, and this is my stock pick of the week. Today we're going to talk about the balance sheet for Paychex, symbol PAYX. And people don't typically spend a lot of time thinking about the company's balance sheets. Usually they're simply worried about the company's products and its reputation. They're worried about the company's ability to generate income, what the dividend are, things like that. But in days like today with the coronavirus, a company's balance sheet becomes extraordinarily important. It might be the thing that saves your company and keeps it in business or not. If you have a strong balance sheet, and by strong I mean you have a lot of cash on hand, you have cash on hand relative to your expenses, you have current liabilities in relation to you have current assets in relation to your current liabilities, you don't have a lot of debt. Those are the kinds of things that keeps you in business through the rough times. Those are the things that allow you to go out and exercise a line of credit, create a line of credit, or issue bonds to get you through if you need to borrow money. So I've always do an analysis of the balance sheet. You've seen all those videos in the past, but now you're starting to understand why I think it's an important part of your consideration. So the first thing that I think we look at in terms of the balance sheet is cash and marketable securities. Marketable securities is things that you could sell virtually instantly and generate cash with, and cash obviously is cash. You'd like to have the company have a lot of that on hand, and by a lot of that I mean enough relative to your current liabilities, enough to pay your obligations and keep you in business should there be some disturbance in your business. And again, we're seeing what a disturbance in your business can look like when looking at the coronavirus stuff. So cash and marketable securities for Paychex has been pretty constant, been between, really call it $350 and $600 million until last year. Last year it got above $600 million and is closing in on $800 million. That's a decent amount. It's actually, you're going to see a little bit anemic for this company for its obligations as we see going forward, but it has been constant, and one of the reasons it's been constant is this company buys back shares and pays dividends, and so they've been returning money to the shareholders, but you're going to see that it does leave them with a little bit less cash than we'd love to have in a perfect world. So this is what I mean by they have sort of a little less cash than we'd like to see. This is a look at the current assets and the current liabilities. So again, to help you understand, current liabilities and capital leases are obligations that you have to pay within the next 12 months. And current assets is money that you either have or expect to receive in the next 12 months. And so when you look at these two, you can see that they've always had sort of just enough to pay the bills. They don't have a lot of excess cash laying around. I mean, again, we're $750 million maybe or something in terms of buffer zone. I don't know if that's necessarily exactly enough. And if this company had this sort of situation and had a significant amount of debt, we'd be really looking at a big problem. We're going to see this company doesn't have any debt, so I think they have the ability to go borrow money if they need to. But these current assets, current liabilities, on the one hand, the company's extremely well managed. They sort of keep enough money on hand, they know what it's going to be, and they've done a good job at managing that buffer over time. And the excess money they've been returning to us, the shareholders, so it's not the end of the world, but if you're preparing for Armageddon, and to some extent a company should, this company's not as strong. I mean, it's probably a 4 out of 5, but it's not as strong as it might be. And in today's day and age, you start wondering about that. Generally speaking, when I look at debt, I don't look at debt in terms of, oh boy, we owe somebody a whole bunch of money in terms of repayment. What I look at debt as is its negative effect on cash flow. And by that I mean interest payments. So when I analyze a company's debt, I say I'm not so concerned about how much money they owe. I'm concerned about how quickly, or how much of our profits are being absorbed every month to pay the interest. So you can see with this company, they have interest expense, which every year but last year has outstripped. They have interest income, which every year has outstripped their interest expense. So they've earned a profit off their financing of their operations. And that's spectacular, that's an A+. Last year, it kind of switched above it. I don't like to see companies where the interest expense is going up. That bothers me. I like to see it, we're paying down debt and the interest expense is going down. But in this case, it went up a little bit, but this company owes so little money that it's not really important. So the first slide just looks at, the red line is interest income, that's good. The blue line is interest expense, that's less good, that's bad. And then the green line shows, did they earn a profit off of their interest, off the balance of those two issues, which has been good every year. And last year they had a tiny little bit of interest loss, but again, nothing to worry about, it's A++. The second thing is, what we have seen is interest starting to go up, and that would normally bother me. But when you look at interest expense as a percentage of operating income, which is a way of measuring how important interest expense is relative to your profits, you see that it's a nothing. It's a blip, it's a pimple, it's totally irrelevant, and it's not something we would worry about. And the important thing about that is, this company, I believe, has a lot of borrowing capacity. So if this company has 18 months of bad years as a result of a year and a half or 2 years worth of bad timing as a result of coronavirus, I think they have the ability to go borrow all the money they need to stay in business, which is one of the reasons why I think Paychex is such a great company. I think that their business model is great. I think they're going to recover as well or faster than the economy. And I think because they have no debt and they have all this capacity to go borrow money, that they're going to survive this thing without any real problem whatsoever. And by the way, as a sidelight, I think that they have competitors who will be less likely or less able to survive it as well. And so it may well be that they come out of this with a higher percentage of the market in terms of beating their competitors. So here you can see the debt analysis. The red is long-term debt. Long-term debt is defined as money that you owe somebody, but you owe them 12 months or more into the future. And then total current liabilities, which is money you owe in the next year. We've already seen total current liabilities versus total current assets, so they have plenty of money on hand to pay that. They have sufficient money on hand to pay that. And then the total long-term debt is really sort of insignificant. It's like $800 million, and the company makes $1.1 billion in profits in a good year, in an average year. And so enough to pay off all of their debt in less than a year. The debt analysis of this company is again, very, very, very strong. But I wouldn't be surprised to see this company take on $2 or $3 billion worth of debt in the next 12 months. And I won't be worried about it because I think this company will do a good job of paying it back. And I also think they'll be borrowing that money at 3% or 2 or 3% interest rates. And so they almost should go borrow the money. So that's it for debt analysis. So one thing that I look at is interest coverage ratio. My investments tend to be companies with very little debt. Because they have very little debt, they have very little concern about interest coverage ratio. But the interest coverage ratio is a measure of the company's ability to meet its interest payments. Interest coverage ratio is equal to the earnings before interest and taxes for a time period, usually 1 year, divided by the interest expense for the same period. So we want the interest coverage ratio to be as high as possible. And for me, I think anything over 3.5 times, I'd like to have an interest coverage ratio of 3.5 or higher. And you can see this company is, for the last 3 years, been above 50 times. So this company's ability to pay its current interest obligations is spectacular. And frankly, if they took on 10 times the debt they had now, so if they took on $8 billion of debt, they have $800 million today. If they took on $8 billion worth of debt, I would still believe that this company would have sufficient earning power to more than cover their interest at a safe rate. So that gives you a sense of why I'm so comfortable that this company will survive this downturn. I almost don't care how bad it is from the standpoint of this investment, because I know this company can borrow the money they need to borrow, and I know that their competitors are less likely to do so, less able to do so. And so this company's going to do really, really well through the recession in terms of coming back the other end and being safe. The final thing that I like to look at in terms of debt is how many years in. So saying a company has a bunch of debt is sort of a meaningless number. If I tell you that a company has $10 billion worth of debt, or $1 billion worth of debt, or $500 million worth of debt, it doesn't tell you much, because you need to be able to put that in proportion to the company's ability to pay that debt back. So I don't worry too much about the number, the exact number that we owe. What I worry about is the year's income to pay off the debt. And so I like to have a company that is making enough money that they could pay off the debt in about 4 years. And this company could do it in less than a year. So if they took 100% of their profits in a year, they could pay off all of their debt and still have money left to pay dividends. So the debt for this company is, as I've said multiple times in this presentation, is not a concern. The balance sheet for this company almost couldn't be stronger. The only way it could be stronger is if they had been just absolutely hoarding cash and not returning any money to the shareholders. And if they'd been doing that, I'd grade them down for that. So I think Paychex continues to be something that I can't imagine won't be a very, very long-term hold for me, unless something dramatic were to happen. So that's it for the video. Again, please subscribe, please like. I'd love to hear your comments. If you're going to put something in the comments anyways, tell me where you're writing from so I can add your dot to the map, so I can keep track of where all my subscribers are. Thanks guys for your time, and stay safe out there.